Bless Squad, what's going on with y'all, man? It's your boy, Blessed Applesauce, here to bless y'all with another video here on Blessed to Invest. And today I want to talk about an important topic. And as you can see from the title, the danger of diversification. In this game of investment, they always say diversify, diversify, diversify. Put your money all over the place, and voila, everything's going to work out just fine. A lot of news analysts and investment people are going to preach that all the time. They say that's like the number one thing, diversify and everything will be okay. But in this video, I want to explain the downsides of diversification, what your risks are, because people don't like to talk about the risk of diversification. They just say diversify and everything's going to be okay. So we're going to talk about the risks, the dangers, and what you need to do to diversify correctly. One, and make sure you're setting yourself up long term so you can be profitable in this game, whatever type of investment vehicle you do decide to get into. But before we get into the video, make sure you spam a like on this video, spam the like button, and also sub down below for more content like this. So you're probably asking, first off, we got to figure out what is diversification. Diversification is simply spreading your money out across different assets. And what it does is it's supposed to limit your exposure and limit your risk. So let's say you buy 100 shares of Apple, you buy 100 shares of Google, you buy 100 shares of Microsoft, and Apple ends up going bankrupt. You lose all your money in Apple, but you still have your Google and you still have your Microsoft, and maybe you still have some other investments on the side. What you did, instead of putting all your money in Apple, you spread it out so you're limiting your downside risk. And that's just what diversification is. So it's just limiting your exposure in case anything were to go wrong. You will be okay. But one problem with this is it also limits your upside potential. So let's say Apple ends up booming and you only put 2 shares of Apple available. You put a little bit in Google, you put a little bit in Microsoft, you put a little bit in maybe like a real estate property or something like this. Apple booms, 1,000% returns, and you only had a couple of shares in there. At the end of the year, you may end up only walking away with maybe a 10% return, 15% return because Apple did so well, but you have nothing really in there for Apple. So that's one of the potential downsides of diversification. It sets yourself up where you're not losing a lot of money if Apple were to tank, but you're not gaining a lot of money where you can actually multiply your money, grow your money properly, and actually beat the market. Also, on top of that, it limits your exposure in a sense where you may not even get returns that are better than the market. So the margin that we're trying to hit, the goal that everybody talks about is hitting the market, getting market returns. And when they're talking about market returns, they're talking about the S&P 500. That market ends up returning about 7 to 10% on average. And that is going to be the metric that you're trying to hit every year in any investment that you get into. If you can't get at least 7 to 10% every year, that is the sign that it's a bad investment. And when you diversify, when you have a little bit of stock here, a little bit of gold here, a little bit of real estate, you're just diversified all over the place into a lot of different investments. What it can do is, even though they may average maybe 5% returns or halfway decent return on a handful of those investments, the fact that you're diversified and spread out so much, you may not get the average market return and you may be below average. And we don't want to see that. So make sure you are diversifying correctly. You're not over diversifying to a sense where you have so much spread out that you can't capture the proper gains. So make sure you're staying clear of that. Next thing I want to talk about is the cost. There's a lot of costs associated with investing. When you buy an investment, let's say you buy a mutual fund, maybe the entry fee is $1,000 for the mutual fund. There's going to be a fee associated with that. Maybe they charge a 1% fee for entry. Maybe they charge a 2% management fee or whatever that may be. If you were to if you had $10,000 and you put it into 10 different mutual funds, you have $1,000 in each mutual fund. You're going to be charged an entry fee on each of those mutual funds. On top of that, you're going to be charged management fees on each of those mutual funds, and that can eat up your returns. You diversify into just maybe 2. Let's say you buy mutual fund A, Mutual fund B, maybe it's like a stable fund, and then the other one's more like a growth fund. You just buy two. You put $5,000 into each fund, and you only pay the management fee for two instead of 10. You're going to help your returns because you're not going to be paying so much money to your brokers. You're not going to be paying so much money to the advertisement and the fees and all the things they like to do within the funds to help you make money. Yes. But if you're spread so thin, you're not going to be making money at the end of the year. So be aware of that. When you're spreading yourself out so thin, you do have to calculate the cost. Even if you're not spreading yourself out thin, you still need to calculate the cost of things and figure out, okay, if I were to buy this, am I getting a proper return on my investment? Because people look at, oh, it got a 20% return, but then they forget, oh, they charged a 5% management fee on top of that. And that really eats into your profit. So pay attention to that when you're diversifying, and don't over diversify to a point where you're being charged so much in fees. On top of that, taxes as well. Once you're diversifying, you need to figure out where the tax benefits is coming from. The two things that are going to kill you in this game are the fees and the taxes. If you have your stuff in a lot of different funds, you need to figure out how I'm going to manage my taxes at the end of the year. For real estate, if you have a couple of real estate property, you need to figure out, okay, how am I going to manage this? Am I going to put this into an LLC? Am I going to hold this for a long period of time? Am I going to flip it? What am I going to do with this property, this investment, to maximize returns and get limit the amount of taxes I pay? One example of this is the IRA. A lot of people get into the IRA to limit their tax liability. So what they will do, they put their money in an IRA. It's going to be a retirement account, and they're able to not pay any taxes while growth is going on in the fund. If you haven't watched my video on the 401k versus the IRA, go check that out. But what it basically does is you put money in, and let's say the money grows at a 7% return year over year, everything's good. All the growth that happens in that particular fund is going to be tax free. So once you pull it out, you don't have to worry about paying any taxes on it. So that's a one beneficial thing you can look out for. So in diversification, focus on the costs, focus on the taxes. You don't want to be paying those things there. Next thing you need to be aware of in diversification, one of the particular dangers is when you're buying a whole bunch of different funds. A lot of people scream diversify, diversify, diversify. They say buy a growth fund, they say buy a standard fund, they say buy a conservative fund, and they say buy a whole bunch of different funds to protect yourself from any risk. The problem is that you need to look out for a lot of these funds tend to buy the same type of stocks. If you look at 2008 and 2000, when we had a lot of these financial crises, a lot of people were big heavy into tech stocks. They had today the Googles, the Apples, the Amazons of the world, and all they had were a whole bunch of companies that were in the same sector. So if one sector goes really bad, you're screwed everywhere because all you're doing is buying the same type of company. So imagine you have a consumer store, and let's say you're buying a whole bunch of consumer goods. You have your Walmart, let's say you have Amazon, let's say you have Target, let's say you have Kohl's, let's say you have all these different consumer stocks, and that's all you own. Let's say, for example, we have a pandemic where people no longer need these goods anymore. Maybe for whatever reason, they don't need the goods anymore. And we find another opportunity somewhere. And now we're getting our goods from, let's say, China. And now we no longer need a Walmart. We no longer need a Target. We no longer need Amazon or Kohl's. And all these stocks end up tanking. You're going to be stuck holding all that money in these stocks because you did not diversify properly. You did diversify. You were in a lot of different companies, a lot of different stocks, but they were all the same type of company. So be aware of that. Don't be buying the same type of company. When you're diversifying, make sure you're diversifying correctly in different sectors, in different stocks. I even stress the point of in even different areas of the market. So don't even buy just stocks. Buy a little bit of real estate, buy a little bit of gold and silver, buy a couple businesses here and there, buy some physical product. Buy different things other than stocks. A lot of people say, oh, paper is the best way to go. Stocks is the only way you can make money. No, there's a lot of different ways you can invest your money. Maybe you want to be a loan officer where you take 10 grand and loan it out to somebody and they give you interest on that. There's a lot of different ways to make money other than just the stock market investing. So beware of that. Diversify all over and don't be just stuck in one type of sector. That's going to really mess you up long term. So beware of that. Diversify, but diversify correctly. And last but not least, the big issue with over diversification is understanding the rules of the game. Each game, each type of investment that you buy, there's going to be a different rule to it. People that do really well in real estate are going to be completely lost when it comes to stocks. People that do really well in business may be completely lost when it comes to buying gold and silver. Even though gold and silver is like one of these easy type investments, kind of just buy it and call it a day. But basically, every investment vehicle that you take, there's going to be different rules to the game of how you play, how you make money, how you invest in it. And yes, there's going to be a lot of people that want to master a whole bunch of different investment vehicles. Yes, that's going to be fine. But a lot of times it takes a lot of time, a lot of knowledge, and takes a lot of effort trying to learn a whole bunch of different investment strategies. So if you over diversify, you're trying to get semi good at one thing, you get semi good at another thing, you're not really focusing and doubling down on things that you could get great at. And when you get great at something, those average returns that you would get on one vehicle turn into great returns. There's a book that was, I think it was Malcolm. It was called The One Thing. Go check that book out. It's called The One Thing. And what it talked about is how people were able to focus on one thing and they got a lot better results than people that were focusing on a whole bunch of things. It's the jack of all trades, the master of none. So focus on one thing. I say recommend focus on a handful of stocks if you're in the stock market. Do like 3 to 5 stocks. Do one or two indexes. Nothing crazy, something simple where you can focus on. If anything moves with it, you'll know because you see it. You see the movement, you're paying attention to it instead of having your eye on 20 different stocks, 30 different indexes, trying to figure out what the Fed's doing with the interest rates, trying to figure out what the market's doing over here and over there. Just focus on one thing, a couple of things, keep it really simple. It gets your education up. It keeps your workload down a little bit and you're able to expand your knowledge on these different sectors that you're working in. So beware of the dangers of over diversification. People like to scream diversification. No, it's about focus. It's about selective diversification. Yes, diversification is important, but make sure you are diversifying correctly and not overdoing it. If you have any questions about diversification, let me know down in the comment section down below. What are y'all buying? Are y'all buying the index? What type of stocks y'all buying? Are y'all looking at Target right now? I'm liking Target. It's getting to a nice price. I think it's one of these companies that's going to be sticking around for a long time. And the way it's at right now, it just looks really good. But let me know in the comment section what you're buying. Let me know. And that's going to wrap it up for the video. It's been your boy, Blessed Applesauce. Stay blessed. I'm going to see y'all next time. I'm blessed. All the best.
Just to see tomorrow is a blessing. Stay prayed up is the message. Everything about a nigga blessed. Everything about a nigga blessed.